Have you ever wondered what it really costs to own a mutual fund or an ETF? It's not just the price of the shares themselves. There's a hidden cost, a seemingly small percentage that can significantly impact your long-term returns. That cost is called the expense ratio. Today, we're going to break down exactly what the expense ratio is, why it's so important for U.S. investors like you, how it works with some simple examples, and what a good expense ratio actually looks like. So what is an expense ratio? Simply put, it's the annual cost of owning an investment fund expressed as a percentage of your assets. Think of it as the fund's operating expenses, things like management fees, administrative costs, and other expenses passed on to investors. These costs cover the salaries of the fund managers, record keeping, legal fees, and everything else it takes to run the fund. Why is it so relevant, especially for U.S. investors? Well, in the U.S., we have a huge culture of investing in retirement accounts like 401(k)s and IRAs. These accounts often rely heavily on mutual funds and ETFs. Even small differences in expense ratios can add up significantly over decades of investing. Compounding works both for and against you. A higher expense ratio means less money working for you and more going to cover the fund's costs. Let's look at how it actually works with some examples. Imagine you invest $10,000 in two different index funds. Fund A has an expense ratio of 0.1%, and Fund B has an expense ratio of 0.5%. That might not seem like a huge difference, right? But let's say both funds earn an average annual return of 7%. For Fund A, your actual return after the expense ratio is 6.9%, 7% 0.1%. For Fund B, your actual return is 6.5%, 7% 0.5%. Over 30 years, that seemingly small 0.4% difference, 0.5%, 0.1%, can translate to tens of thousands of dollars in lost returns. Let's do a quick calculation. Investing $10,000 at 6.9% annually for 30 years gives you approximately $81,863. Investing the same amount at 6.5% yields about $74,481. That's a difference of over $7,000 just because of the expense ratio. Now let's talk about how these ratios are calculated. The expense ratio is calculated annually, but it's expressed as a daily percentage and deducted from the fund's assets each day. This means you don't see a separate bill for the expense ratio. It's already factored into the fund's net asset value, or NAV. You can easily find the expense ratio for any fund in its prospectus, which is available on the fund's website or through the SEC's Edgar database. Just search for the fund's ticker symbol and look for the section on fees and expenses. So what's considered a good expense ratio? It really depends on the type of fund. For passively managed index funds, which simply track a specific market index, you can often find expense ratios below 0.1%. These are generally considered excellent. Actively managed funds, where fund managers try to beat the market, typically have higher expense ratios, often ranging from 0.5% to 1.5% or even higher. The thinking is that the manager's skill should justify the higher cost. However, studies consistently show that most actively managed funds don't consistently outperform their benchmarks, meaning you might be paying a premium for underperformance. There are also things called load funds. These funds charge a sales commission, either when you buy front-end load or sell back-end load shares. These loads are separate from the expense ratio and can significantly eat into your returns. It's generally best to avoid load funds altogether. When choosing a fund, don't solely focus on the expense ratio. Consider the fund's investment strategy, its track record, and whether it aligns with your financial goals and risk tolerance. But always pay attention to the expense ratio, as it's a crucial factor that can impact your long-term investment success. To recap, The expense ratio is the annual cost of owning a fund, expressed as a percentage of your assets. Even small differences in expense ratios can have a big impact over time. Look for low-cost index funds when possible and avoid load funds. Always read the fund's prospectus to understand all the fees involved. Remember to consider the expense ratio alongside the fund's investment strategy and track record. By understanding the expense ratio, you can make more informed investment decisions and maximize your returns over the long run. It's a simple concept, but it's a powerful one. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.